Welcome to Bunnex Investment Group. By the end of this video, you should be able to add in to your winning trades as shown below. This particular case is called JPY example, a trade that we took a long time ago. As you can see, the first entry was actually this one. So it was a buy. Then another entry was added at this particular point. So this is actually how you add in when you are right on a trade. A lot of traders add in when a trade is in negative, hoping that when they add, the market is going to react from that action. All right, so let me teach you how exactly you need to do. However, we'll incorporate some EMAs to help us catch the right points to scale in. Let's now have a small explanation behind the theory. All right, firstly, to be successful in trading, we need to be hard-coded in our minds. Every weak trader will be chucked out of this business very quickly. This means if we get a series of losses, we should be able to remain straight-wired in what we do. The only thing that separates consistent traders to inconsistent ones is they can repeat the same process over and over again, no matter what they face along the way. So if you are someone who actually starts to think of new strategies, who starts to think of new mentorship when you face a series of losses, know that you are not going to succeed within this business. So when you are right, a trade must pay you more through scaling in more positions. We are saying not every trader, or there is no trader under the sun that can trade with a high accuracy of 95 to 100 or 90 to 100 like what most traders think. Most professional traders actually averages on an accuracy rate of 50 to 60%, sometimes lower than 50, that is 40, 45, and I've seen professional traders who are making money consistently with a 20 or 30% accuracy rate. How do they do so? We are saying when they get a right trade, because along the trials you are going to get a good rightful trade which can allow you to add in and make more money that can recover all your losses. So scale in are made at microscopic contract accumulation as shown below. In this particular case, we can see this is the law of day, which is actually the price point that each and every trader will be looking for each and every day. And along the way, we have what we call microscopic accumulation that is done by market makers. These accumulation phases are actually done on the M1, M5 time frame, which we are not interested to look at. We have a technique that I'll actually review as we go with the video. So basically, within these microscopic accumulation, that is where we make our scale ins. We are saying our first entry will be probably around this point, which is after confirmation of law of day using several techniques available in the industry. Then after that, we can see a microscopic accumulation where we can add in the first add in position or first scale in position, second scale in position, and then we exit all of them when we approach the high of day or the high of week or end of the market maker cycle, right? So here are the scale in rules. For the scope of this lecture, we will not delve in entries and patterns where we are going to make our entries. That is actually a different topic for another video. However, our points of market entries looks to enter at the law of day using several setups. So most setups are trying to buy the dump or sell the rally. If I have made the mistake, it's actually vice versa. But we are trying to catch the highs or catch the lows. When we catch a high or a low and the market goes in our favor, it's now time to make most of that move. So the principles apply in all trading strategies that looks to trade from extremes. By extremes, we are saying any strategy that looks to make entries at highs or at lows can actually use these scale in rules. So when market sets a daily low, which is the low of any market phase, it moves in three best patterns to connect two different sessions. We are saying when the market creates a low in the London session or at London Open, it creates a 3 best pattern movement to create the London and the New York. This can also occur between the Asia and the London, or the US and the Asian session, whatever the case and whatever the trading pair you are looking at. So these bests can be seen as a rhythm that beat as push 13 EMA, push 13 EMA. So we are saying this push is segmented, or is actually segregated from this particular push by a 13 EMA, another push 13 EMA. And this is done with secrecy as much as possible so that it won't be as clear as what we would expect. But I'll actually show you when we get to the charts. Therefore, making an entry at low of day, we need to look for 13 EMA touches to identify the microscopic accumulations. So when we see these microscopic accumulations, we know that that is the very point to make our scale ins, and our scale ins can be the same lot as we used earlier, or we can use half of the initial lot that we entered in the first place. So at each 13 EMA touch, a position is added. Let's now have examples of what I mean on the charts. But before we see examples, please note that we have a free Telegram channel where we share free signals, free setups, and trading tips. Make sure to join only using the link that I've put in the description box below. Alright, so this is gold against US dollar. It's actually a live market. I've made some entries on this particular pair for level 3, and I've actually shared it with the VIP members where I share all my signals. So in this particular case, it's actually a setup that has been issued in this particular way. For now, I have already entered, or I have already added more positions within this particular flow. So the first position was actually at low of day. As you can see, I mentioned that waiting for candlestick reversal pattern at yesterday's low. It was before all this had happened. So the market satisfied this anticipation where we were expecting to see the market to come at yesterday's low like that, and it was actually a valid low of our current day today, right? Then after that, we can see the market shifted from this point, right? From this particular point, made the first best to the upside. If we look closely, we can see that after the first best, we had the first retest to the 13 EMA, which is the one in red. This now marks the first microscopic accumulation that has been issued by the market makers. So we are now waiting for the second best and then retest of the 13 for us to get another point of scale in, right? So if we go back in history, we can try to find these points as well. We can see that in this particular case, we had a buy pattern, which was an inverted head and shoulders, first shoulder, head, and then the second shoulder. This was a valid point of market entry as it was actually the second shoulder, and it confirmed to be the low of that particular day. From this particular point, we had the first best to the upside, microscopic accumulation as retest of the 13 EMA, second best to the upside, retest of the 13 EMA, and then the third best to the upside to reach the end of that day and actually create the high of that day. Therefore, our scale ins on this particular case, the first trade was going to be somewhere around after this as the candlestick reversal pattern confirmed at this point. Second best, first best, then first microscopic accumulation, second microscopic accumulation. Therefore, we had 1, 2, 3 entries on this particular trade. If you are looking closely, you can see that we are only adding when the market is in profit and when it is satisfying what we look for, which are the microscopic accumulations. Another example, we can see this was a trade that we also took last week. It was Euro GBP, and on Euro GBP we entered a buy trade whereby we had first rise, right? Then second rise, 2 levels to the upside, and we were expecting the third level to the upside. Unfortunately, I haven't prepared the initial markup. So in this particular case, our first trade was actually going to be at this point, which we entered at Asian session low. After entering at Asian session low, we had our first rise, first best to the upside, right, which retested the 13, then second best to the upside, another scale in point. So we now had 1, 2, 3, and we reached the high like that. So basically the market will issue these bests, and in some cases there will be smaller bests, and in some cases there will be bigger bests where you can see with ease. In this case, we can see that we had a reset point. This trade was also shared with the VIP. All the trades that I'm showing you were shared with the VIP. We had the first rise, right? Then we had the second rise like that. It was a very good trade of June, pound USD buy, and after that this was the third rise which we anticipated. So we had seen first and second levels, and then we were anticipating the third level. We can see that on this particular case, our first entry was made at this particular point after retesting the low of the Asian session. Then after that, we can see the market went straight up without any retest of the 13, and then it came back to the 13 at this particular point, another retest of the 13 at this particular point, and the cycle was completed. So basically we are saying we need to see 2 touches of the 13 EMA after a best to the upside like that. And if that's the case, we can now scale in with ease. On that note, we've come to the end of our today's video.